Good afternoon, ladies and gentlemen. Very welcome to our very special edition of Market Masters, and we have an equally special guest for you. For the third time, Mr. Ravi Dharamshi, founder and CIO of ValueQuest Investment Advisors, joins us. He first graced Market Masters on August of 2023 when the Nifty was 19,250. Then he came back in mid-February on 19th of February when the Nifty was at 22,100, and today we have him at 24,000 after hitting a record peak of 25,000 on the Nifty. Good afternoon to you, Ravi Bhai, and a very warm welcome. It's a very special day to welcome you when the market is down 800 points on the Nifty alone. How do you feel? Is this a time to step back into the markets or is this a time to pause, reflect, and maybe take some more money away from the table?
Thank you so much for having me. And no, I think it's the long-awaited correction that we have all been waiting for. It's been over 4 years that since the bottom of COVID that markets have been rallying relentlessly. So this was expected. It's not totally unexpected. In fact, when the election results came out, we thought that could turn out to be a reason for a correction. Then the way the budget panned out and the capital gains tax was increased, I think that too, a lot of us thought that could turn out to be the reason for correction. Market kind of digested those two events quite well, but what is happening today in the world is the unwinding of the yen carry trade, and that liquidity has a direct impact on the markets for sure. Though I think to some extent this entire crisis is manufactured globally, should have a limited impact on Indian markets because India has not been a large beneficiary of global flows. So yen carry trade unwinding will lead to global flows going out of India. And over there, I believe FII holding is at a 11-year low. I think it's touching close to 16%. That tells you that not too much of hot money has flowed into India. So maybe $2, $3, $4 billion of outflow cannot be ruled out, but it cannot be a very substantial number is what I feel. So India is more a collateral damage. Of course, we were one of the few markets which were rallying hard and are sitting on a lot of gains. So if our FIIs are hurting elsewhere, they will try and take some money off the table in India as well. So I think correction is par for the course, and I think it might run some more from here.
Exactly the point that I wanted to come to, sir. You said that some more. How much is some more, sir? If you could tell us, how much should we be prepared for?
So, see, there is no magic formula that how much it has to correct. But I would like to answer that in a way. See, there is one thing which is market cycle, and then there is another thing which is economic cycle. And from economic cycle point of view, I don't see too many reasons for us to dramatically correct. So usually when there is a market cycle and economic cycle both peak, that can lead to a major top in the market. So and that leads to anywhere close to a 30% kind of a drop on the index is possible. But because this is only a market correction or market cycle correction rather than an economic cycle correction, I would presume it to be less than that. Now, it is anybody's guess how much it ends up being, but 10, 12, 15% would be absolutely par for the course is what I feel.
Okay, let's just stick to the first number, which is 10%. So from 25,000, which was the most recent peak, we see 22,500 possibly coming in. This is of course the first halt. Let us see what goes beyond that. Dharmeshji, at the moment, Ravi Bhai, at the moment you manage 16,500 crores over 5 different portfolios. What is your view on mid caps and small caps at this moment? Because all put together they are about anywhere between 60 to 65% of overall investment. Are these overheated? Is there a chance of a sleepless night that you would spend?
No, so I think definitely this is a time when one has to be very sure of what they own. If there is a company which is a small company, does not have liquidity, and it has business issues, then you need to be very, very clear why you own it and would you want to continue owning it. So just because there is a liquidity issue might not be a reason enough to get out of a particular company. If it is accompanied by also turn of events on the business front, then that is a lethal combination. One should be away from that. Clearly, valuations are on the higher side, and what we don't want is performance deteriorating and then liquidity drying up in the market. That usually leads to a drawdown in these companies anywhere from as much as 50% also, or it could be more also. So those are the areas that one should be worried about. However, I don't necessarily look at the market from the prism of large, small, mid. I look at it from the prism of what businesses, what sectors are going to do well over the next 3-5 year horizon. And over there, if I find that a company that I own, where I have the confidence in the outlook, and the stock prices have corrected that much, then that might actually be a reason for me to buy some more. However, what is again, I'm the key operative word over there being that confidence on the outlook. One has to be very sure that the companies are going to perform. Then I don't think the market correction should deter from adding more to the position.
And Ravi sir, another thing is like, once the correction say of 7-10% odd is underway, what would you look to add? Which are the key sectors that will fresh flows find their way in?
So one thing, one area which we have been avoiding since last a year or so has been stories which are too tied to the central government capex. Now we all know that for the last 4 years, central government has been the one carrying the burden of capital expansion. However, I feel incrementally going forward, government's hands are a little tied up over there in terms of further increasing the rate of growth over there. I'm not saying the capital expansion will stop. It's just that if it was growing at 30% earlier and it had slowed down to 20%, I think it will further slow down to somewhere between 10 and 15% going forward. Because now the priorities change from fiscal discipline and also welfare. So at the state level, it is more welfare oriented, and at the central government, it is more fiscal discipline oriented approach, and that is leading to incremental capex being a little subdued. Now, government is trying its best to pass on the mantle to the private sector. They want private sector to pick up the gauntlet. I think they have done everything on the trying to do everything on the incentivizing in terms of taxation, incentivizing in terms of recruitment, trying to leave enough leeway on the borrowing side. So capital, labor, everything they're trying to make this available cheap for to the private sector. And I think give or take a few quarters, that cycle should pick up. So the mantle should pass from government focused capex cycle to a private sector focused capex cycle sometime in the next 2 to 4 quarters. But for maybe initially, because of the way the world is correcting, the sectors with the most momentum are the ones that will bear the most brunt as well. So railway, defense, some of the public sector banks, I think those are the sectors that one should be avoiding. From what looks good from the next 3 to 5 years perspective, we still continue to like large private sector banks. We continue to like insurance companies, general as well as life. We continue to like some, again, as I mentioned, private sector capex focused companies, and some capital market beneficiaries which are more secular in nature and not necessarily dependent on the short term market performance. So those are some of the sectors that excite us from the next 3 to 5 years perspective. Sorry, I forgot to mention one more, which was energy transition.
Absolutely.
That continues to be a theme that we continue to like. Within that, power transmission equipment is something that we like.
Okay. So the three broad themes that you had mentioned in August last year continue to gather your attention. Clean energy transition, of course, private sector banks, and the financialization of assets that is broadly playing out fairly well in the market, including the insurance space. This is the market that we've often discussed, Ravi, but where do you find true value? I mean, your name is, of course, ValueQuest, so the search for value remains. And between the time you came to us August last year and now, what has really happened is that wherever was value, that's been converted to momentum. But as a job of managing PMS money and deploying funds, that's your primary task. Is it getting difficult now?
So there are some pockets of areas in the market where wealth creation has not happened to the extent where the rest of the market has been performing. For example, whether it is consumer-oriented companies or whether it is chemical companies, for example, even insurance companies, for all practical purpose, have been started performing only in the last 6 months.
Yes.
So these are the areas where I believe that extended overvaluation does not exist. Again, market does not move in a linear fashion, so step down is always possible if the stock prices are corrected. But from the perspective of next 3 to 5 years, I believe these are areas that do offer some value, but we usually don't tend to enter a particular sector just because it is deep value. We like to identify catalysts, triggers that become visible on the horizon, and then we place our bet. So these are sectors that we keep on our radar, and then we enter when we believe the catalysts have presented themselves. So, for example, insurance companies had been on our radar since a while, but it is only when we saw that the private equity funding to some of the competition had dried down. Now these players are trying to come to the market to get listed, and their focus is shifting from gaining market share towards getting profitability. That is when we understood that now this sector, which was very highly valued 5 years back, has become attractive, and now the competitive intensity in the sector is reducing, and this is the time to be placing our bets. So from that perspective, consumption and chemical exports are two sectors that we do keep on our radar, but we'll wait for the catalyst to present itself.
Ravi sir, another thing that I wanted to discuss and understand is, in fact, we'll take first of our viewer question and then I'll come to my question as well. From Noida, Anuj wants to know how are you assessing the consumption theme now post the budget and the FMCG sector? Is this the safe haven that one should look at?
So right now, I think very rightly said, it is more a safe haven and a kind of a defensive play that market is looking at it. But when we usually try to look at it, we look for those triggers. So there have been many small incremental things that have happened for the consumption to revive. So first of all, it's been 3-4 years that the latent demand has been there. Second, there has been some increase in the MSP levels. Third, there has been some increase in the welfare at the state level. Fourth, there has been some increase in terms of wages and employment. But we still don't feel that we have reached the stage from where it is a given that consumption cycle will revive and come back in a big way. So that is why right now it is more a hiding place rather than a growth area in the market. That's how we are looking at it.
One important thing that's happened in the consumption space is actually over the last 4 years, there has been a time correction, but neither the valuation has gone down and neither have the prospects of these companies improved. So it's a status quo. Today, the top gainers are Lever, ITC, Nestle, Britannia. You were saying something, Ravi.
What has happened is the relative valuations became attractive. It might not be
Yes.
absolute valuations didn't get attractive,
Correct.
but as compared to some of the manufacturing and capital goods stories, they became slightly attractive. So that's why the money is flowing towards them.
Absolutely. In front of this, if this is the size of a line, you draw a bigger line for capital goods as well as other shares. So this one starts to look attractive, whereas nothing much has happened on the size of this particular line. Ravi, let's look at the other part of the market, which is IT. There was some expectation about 3-4 months ago that the sector has been sort of stabilized and you might see some decent returns coming in. Of course, they came, but one of the biggest, how should I say, negative sentiment that we see globally now is on IT. How do you analyze domestic IT exporters against the light of artificial intelligence not working in the US but creating havoc for our guys because we have stopped hiring talent?
Yeah. So see, one thing we have to understand with what stage the IT industry cycle is in. It is in a very mature stage. These are large companies now, even in global context, and these companies cannot grow their earnings at a 15-20% compounded, what we are used to for a long period of time. And on top of that, now we have this threat of AI, which might lead to efficiency improvement over a period of time, but currently it is leading to less and less of manpower hiring. And manpower hiring is 1:1 correlation with the growth in the IT sector.
Absolutely.
So, if there is a stoppage in the hiring, that directly reflects on the growth prospects of the IT services industry. But having said that, I think IT is not only related to the IT services that we tend to think of. There are many other segments in the market. There are product companies, there are platform companies, then there are technology-enabled business models, which could be more consumption-oriented or those kind of sectors. And I think some opportunity does lie over there. So I am not very gung-ho on exports of IT services, but I think there is a need for them to reinvent themselves. They haven't invested enough on the R&D side to give multiple engines of growth needs to be developed. I think that has been lacking, so that's what's a little concern for me. I'm not very gung-ho about the IT sector.
Not very gung-ho about the IT sector. Interestingly, Ravi, even you will appreciate what Mr. Anand Mahindra has tweeted just a while back on the Indian market crash. He's written, "Never a better time to deploy the ancient Indian practice of pranayama. It's about breathing deeply and looking inwards." What I see is an India that is an oasis in the world, whose rise will not be impeded in the medium to long term. Play the long game. That is what his advice is to the viewers. I'll ask you as well, what is it that you do when such events of sharp crash really happens? It's happened at least twice in the last 2 months for us to see such a sharp fall on an intraday basis. And of course, you have seen it like much longer and, many instances like that. What do you do?
No, so you know what, we have seen everything in the last 20 years, 2 decades. Market has thrown everything at us, from dot-com bust, 9/11, all the way to global financial crisis, currency crisis focused on India, GST, demonetization, NBFC crisis, COVID. So market has thrown everything at us, and the only advantage of having the experience in the market is that it teaches you that in the long run, as an asset class as well as a nation, India will go up. However, for the longer term, we have to live through the short term as well. So the responsibility is ours to ensure that we survive whatever the short term is. It doesn't matter how bad it gets. It shouldn't throw you out of the game. So the rule number one, or the job number one, is to ensure that when the tide turns, you are in the saddle. And then you will have enough opportunity to take advantage of the upcycle.
Let's talk of the upcycle, Ravi. This year budget, the nominal growth projected of GDP was anywhere between 10.5 to 11%. And between last August and now, the domestic inflows have sort of gone up to about $4.5 to $5 billion a month. That's a fresh 50 billion a year. How do you see this liquidity, one, continuing because of the pain that we see, And should it continue, where do you think are fund managers insistent upon deploying it? Large caps, do they merit more attention than mids and smalls?
No, so, first of all, I think it's a secular theme that is panning out, the rise of the equity culture in India. I think if you were to map out over the last 4-5 decades how the equity culture has panned out in India, it was kick-started by the CCI in terms of getting all the companies listed, followed up with Reliance that actually gave a lot of fuel to the equity culture, and then Harshad Mehta that kind of increased that equity culture. But then we had a long pause where people thought that markets are a gambling den and there are always scams lurking. So that kind of put markets back for a long period of time. But I think now the new equity culture that is starting out is much more durable and sustainable, because one, the it is coming through institutional mechanism. The money is flowing into mutual fund, money is flowing through SIP, money is flowing through PMS, AIF. And it is, of course, there is some direct flows also, but insurance, EPFO. Now we have developed large pools of domestic capital, and the number might change. If there are $4 billion a month coming, probably that number can fall to 3 billion or it can increase to 5 billion. But I don't think that number is going to dry down and go to zero or any such thing. So this is definitely a sustainable trend, and that will always provide a lot of cushion in the market. So relatively, India will continue to outperform over the medium and long term as compared to a lot of the other markets.
In fact, we have another question with respect to the global markets as well from our viewer from New Delhi. Simran Singh wants to know from you, sir, how much should global markets really affect our investing decisions in the Indian markets? What would you suggest?
So markets are a mechanism where you refer to the market to see whether it is offering you a bargain or no in terms of doing your investment. And often enough, global markets have presented a reason for Indian markets to correct as well, which seems to be the case even right now. So does that lead to finally do we get the bargain prices that we've been waiting for? Again, I'm not waiting with bated breath for us to get anything like COVID kind of prices or anything. But this will finally provide some better entry point that a lot of money is waiting on the sideline for. So I think from that perspective, we look at global markets only to understand whether that causes a short-term correction in India or no. Of course, if this turns out to be a much deeper malaise and some kind of a crisis unfolding in the world, then it can have a deeper correction as well. But at this juncture, it doesn't look like. It looks like an unwind of carry trade. It looks like monetary policy shifting by Bank of Japan towards raising rates and from US towards cutting rates. So I think that's the adjustment that we need to do, and I don't see this as a start of a big crisis or something.
Let's address two other sectors, Ravi, which is specialty chemicals and pharma. Over the last 6 months, both of them have shown traction either because of rising exports of specialty chemicals or good numbers coming in on the pharma side as well. Have you been shopping in this space over the last 6 months or so, or you've stayed away?
Yeah. No, so clearly these are two spaces where we have been adding to our position. As I mentioned, we have been reducing our position in railway, defense, those kind of names, and we have been increasing our exposure to chemicals, pharma, and I think purely because one, they had not performed for the last 3-4 years, and also the fact that some amount of revival is happening. What happened, especially in the specialty chemicals case, is that post December 21, there was a lot of Chinese production that came on stream, and that led to dumping in the Indian market. So that kind of really messed up the Indian chemical makers' spreads, and some of the companies even made losses. So the performance in terms of quarterly results is not yet out of the woods, but I think the valuation had corrected itself sideways, and now some improvement or some signs of bottoming over there in terms of fundamental performance is leading to the stock prices performing. So, I mean, I don't know whether this particular trend will how long it will continue, but I think the odds are in our favor that we should place our bets in case there is a correction over here, because the worst of the performance seems to be behind us.
Question to you, Ravi Bhai. Your mentor, Mr. Jhunjhunwala, was a great believer in India's ability to not only outperform but to give stellar returns compared with other asset classes as also other markets. What would he have done in this kind of a market?
I'm sorry, I missed the question. If you can repeat.
Yeah, I said your mentor, Mr. Rakesh Jhunjhunwala, was a firm believer in India's long-term outperformance vis-a-vis a lot of global peers. In this kind of a market, what do you think he would have done? Nifty down 700 points, Sensex down 2,500 points.
So he would have squared off all his leveraged position for sure, paid it off by selling a little bit of his investment if need be, and sat on the sideline waiting for the markets to stabilize, to deploy more money, and stayed bullish on India more than ever in his demeanor.
Yeah.
Wonderful. I think that's the best answer of the last 28-minute chat, that he would have squared out all his leverage positions, sat on cash and waited for a better day to emerge. Thank you, Ravi Bhai. As always, for the third time we are having you here, and we hope to have you many more times to understand the dynamics of this wonderful bull market, which is at the moment showing a minor correction. Thank you so much for your time, sir.
Thank you.
That, ladies and gentlemen, was Ravi Dharamshi, the founder and CIO of ValueQuest Investment Advisors, one of the finest stock pickers that I have had the pleasure of knowing over the last 25 years. He manages about 16,500 crore rupees. He's not a bit worried about how this correction is panning out. He says this is a par for the course. And at the moment, he's hunting in the chemicals and pharma space. He sees value in in private sector banks, as also insurance and life insurance companies, and of course the energy transition theme. I hope you enjoyed this conversation as much as Sakshi and I did, and let's wait for another very good conversation to begin in a short while from now.
In the last few months, global economic activity appears to be strengthening across advanced economies and emerging market economies. Global trade is gathering momentum. Inflation is approaching targets, but the pace of disinflation has somewhat slowed down. Central banks are closely monitoring